Have you ever wondered how investors can own hundreds of different companies at the same time, yet invest in all of them with just a simple click of a button? That's the magic of ETFs, a phrase that I'm sure you've heard lots before. It stands for Exchange Trade Funds. In this video, we're going to go into detail about what an ETF is, what the pros and cons are, how you can start investing in them, and what they mean for your financial portfolio. My name is Lewis, and here we talk about anything to do with personal finance, growing your money, and how to make your money work for you. And today, as mentioned, we're going to cover ETFs. We're going to break down exactly what they do and exactly how you can invest with them. So let's get stuck in. ETFs are one of the most popular ways to invest in today's society. But why is that? They've grown significantly in popularity since the 1970s, the 1980s, when they first started to appear. And since then, their popularity has grown exponentially. They've been advocated by big investors such as Warren Buffett. But what we want to do today is break down exactly what they are and why you should consider investing in ETFs. So what exactly is an ETF? ETF stands for Exchange Traded Fund. Think of it like a basket of goods, and in that basket you've got a selection of things. When you go to the supermarket, you buy a variety of things. That is effectively what an exchange traded fund is. It's a collection of a variety of different stocks, all from different companies, all sitting within the same basket. And when you invest in it, you put your money in, you purchase a small slice of each one of those individual companies. It doesn't just have to be stocks and shares either. It can be things like bonds or commodities, things like barrels of oil and things like that. There's all sorts of different things that you can have in an ETF. It's just knowing which one is the right one for you that's key. And as mentioned, when you buy into that ETF, you're buying a very small percentage of all of the companies that are inside that ETF, depending on the percentage of the overall portfolio they make up. So if there was, say, 20 companies in an ETF and they make up 100% of that ETF, then every time that you invest your money, you're buying 5% of each one of those individual companies. Let's say you want to invest some of your money into the S&P 500, the collection of the 500 biggest stocks over in America. If you wanted to do that and you put your money into a fund, a really popular one is a fund owned by Vanguard, the Vanguard S&P 500 ETF. If you were to put your money into that fund, then however much money you're putting in, it would go into buying a small portion of the 500 companies that make up that fund based on how they split up the overall pie. So let's take Microsoft, for example, and let's assume, I don't know the numbers off the top of my head, but let's assume that Microsoft represents 5% of the overall ETF value. That means that 5% of the money that you put in, so if you were putting in £100, that means £5 of it would then be invested into Microsoft. And that's how your money gets split up across all of the different companies within the ETF. It also means you get exposed to lots of other companies as well, companies like Apple or Nvidia, the most valuable company in the world at the moment, Amazon, Alphabet, the owners of Google. All the big tech stocks make up part of the S&P 500, plus lots of other stocks as well from lots of other industries. And that's another really important thing about ETFs. Depending on which one you buy into, they often give you good diversification across different industries as well, which is really important for a balanced investing portfolio. ETFs are traded on stock exchanges as well, just like a regular stock and share. So you can buy and sell them at any time and their value increases, decreases every day, which makes them a really liquid form of investment, which is another reason that makes them so popular. So let's have a little look under the hood about how ETFs actually work. So how do ETFs work? Let's take a really popular company that operates in the ETF sphere, like Vanguard or like iShares. They will set up an ETF by picking which assets they want to make up their fund. And once they've decided which assets they want to make up their fund, that then makes up the entire portfolio or the entire ETF. Then large institutions such as authorized participants will then buy up those assets and they will exchange them for ETF shares. Those shares are then what are traded by you, by me on the open market as then the value of that ETF. So when it's all been bundled together by the company that is creating the ETF, and then all of the individual assets have been bought and exchanged for ETF shares, those shares are what goes onto the market, and those shares make up a representation of the entire portfolio. By doing this, what it means is that ETFs stay really closely tracked to the company's value that make up the ETF. So that is called tracking. So when a company inside the ETF, when it grows, the ETF grows as well. If all of the companies grow, the ETF grows really well. The same can be said on the other side, though. If the companies actually draw back and they lose value, the ETF also loses value as well. And here's a really important point, I think, probably for me to interject that say, obviously, ETFs is a form of investing. If you're going to be going into ETFs, then you are going to be investing. When investing, obviously, your money is at risk, and that means that your money can go up and it can go down. So, everything we're talking about here today is explaining what the ETFs are, but at the same time, it's important to state that there is risk. And if you put your money into an ETF, you may see growth or you also may see your money decline. But in general, ETFs are viewed as a slightly safer way of investing than picking individual stocks, because by going into an ETF, you've got a broad blanket coverage of the market and you don't have to go and pick all the individual companies that you think are going to grow in the future. Instead, that bit is done for you. And by putting lots of companies into the same ETF, it diversifies your risk, which allows you to ride some of the ups and downs that the market can see better than if you were picking individual stocks. Now we know what they are, let's look into what types of ETFs there are out there. And to be honest, I'm going to probably caveat this at the start. There are literally thousands of ETFs out there that you could invest in, which I appreciate can be a really daunting kind of position to be in, especially if you're going into the market in the first time. So here are just a few examples of the main types of ETFs that you see out there. The most popular type of ETF out there is a standard stock ETF. So it tracks things like the S&P 500, the FTSE 100, the NASDAQ, also stock exchanges in other countries as well, all across the world, or even ETFs that go and bring in companies from all across the world as well. They're the most popular type of ETFs because they cover a broad range of stocks and shares that helps diversify your risk across different industries. There's also bond ETFs, so this is where your money is invested in either government or corporate bonds, and your money goes and is locked into those assets instead of it being in the stock market. A great option if you're looking to actually de-risk your portfolio a little bit. Bond ETFs tend to be a much safer, and bonds in general tend to be a much safer form of investment because they have a more fixed growth and are much less risky than investing in stocks and shares. But on the flip side, you're likely to not see the same level of growth as you would get out of the stock market. There's commodity ETFs. So commodity ETFs give you exposure to actual physical assets, commodities that are exchanged and traded on a daily basis. So think of things like gold. I'm sure you've heard of people investing in gold, or oil is another really popular one. Anything that's a physical commodity like that, there is an ETF out there that allows you to be able to put your money into that if that's what you decide you want to invest in. There's sector or industry ETFs. This allows you to focus on specific parts of the market. So if, say, healthcare is something that you really want to invest in, there are ETFs out there where you can put all your money into an ETF that's been created that only has healthcare companies in, or there's lots of different examples of specific industries, whether it be defense or consumer goods. There's lots of other examples out there of ETFs that are just focused on certain areas of the market. Again, these are great. If that area and that sector booms, you're in the right place. But at the same time, if that area or sector declines or receives an outward shock into that particular industry, your money can draw back quite rapidly. So definitely sector ETFs I would approach with caution. And if you're thinking of setting them up in as part of your portfolio, definitely look to have them as a small part of your portfolio rather than the whole thing. And then finally, there's themed ETFs. These focus on things like clean energy or AI technology. So you can invest in ETFs that solely focus on companies that are just working on that specific tiny niche in the market. Again, the same as the previous point, really, in that it's great if that market booms, but don't put all your metaphorical eggs, all of your investment into one basket, because if that industry declines or something happens that means that that industry isn't performing so well, you can lose a lot of money really quickly. So that's kind of all of the key probably types of ETFs there are out there. And I would say you want to be putting together a portfolio that actually consists of a variety of all of them, depending on where you are in your investing journey. If you're younger and you're looking for lots of growth, then you're probably leaning more towards the stocks ETFs that I mentioned at the start, maybe supplemented by a couple of those specific industry ETFs if it's something you're really passionate about. If you're moving towards retirement, you actually might want to be moving your money out of some of those categories and more into a bond ETF, which gives you a more kind of solid growth, but might not reach the full potential of growth that you could get from the stock market. So yeah, there really is an ETF out there for pretty much anyone, to be honest. So yeah, it's something worth looking into and having a think about what your specific focuses are and where you want your money to be, because that will help guide you where you should put your money and what ETFs you should put your money into, if ETFs is something that you want to do. We've sort of covered it already throughout this video, but let's now look at some of the pros and some of the cons of ETF and what actually you might factor into your decision making when deciding if an ETF is right for you. The biggest pro of ETFs is diversification. So by diversification, we mean that your money is spread across multiple different stocks, shares, commodities, whichever ETF you decide to go in, your money is diversified. It's split across all of the different options. What that does is help you mitigate some risk, and your money's not all in one place, so that if that area of the market were to perform badly, not all of your money comes back. So take the S&P 500 example that we mentioned earlier. That covers the 500 biggest companies over in the United States. Now, there's a lot of tech companies near the top end of that. We've mentioned them already: Nvidia, Apple, Amazon, Alphabet, Meta. They make up big portions of the S&P 500. But also in the S&P 500 ETFs, you have other industries. So Home Depot in the consumer goods area, or JP Morgan in the finance industry. Your money is diversified across a variety of different assets and industries, so that if one pulls back, that doesn't necessarily mean that your money goes into a drastic decline. Secondly, ETFs tend to be low cost and have low fees as well. So all of this is about you being able to make more money. And there's nothing worse than your money then going into fees. So you're getting money in and then you're leaking money out the back. Instead, with ETFs, the costs are very low, which means that the money leakage you have out of your portfolio tends to be fairly low. Using a platform such as Trading 212, for example, which is what I use for my investing, is a really great example of using a fund that doesn't actually have, an app that doesn't actually have many fees. It allows you to move your money around assets really easily, and you don't incur much financial penalty for it. I should say that Trading 212 are not a sponsor of this video. That's just an app that I choose to use for my personal investing. ETFs are also really liquid. That's another example. By liquid, it's probably a phrase that you'll hear a lot, but in the finance world, what liquid means is that your money can move around freely and very easily. And that's exactly what ETFs are. You can buy them, you can sell them quite literally at the tap of a button or click of a button on your phone. You can move your money out of one ETF and into another just like that. And that's a really good advantage of people wanting to be able to move their monies into places that they want it to be, depending on how their portfolio is performing. And also, ETFs are really transparent. That's kind of the final big advantage, really, is that you can see, if you click into your ETF, you can see exactly where your money is invested. So again, using the example before, if you went and found the Vanguard S&P 500 ETF on Trading 212, you click into that, straight away you'll be able to scroll down and you'll be able to see all of the different companies that are inside that ETF and what percentage of that ETF they make up. So yeah, it's really, really straightforward to be able to do. But of course, where there are pros, there are also cons as well. So it's important to consider those when making a decision about what you want to do with ETFs. Probably the first con that springs to mind, but this is a con that applies to all investing really, is that if the market goes down, the value of your fund is probably going to go down as well, the value of the money that you've invested. And this is particularly true for ETFs, if there is a wider financial crisis, recession, something heavy impacts the market and impacts the market in its entirety, then the value of your ETF is probably going to go down because you're diversified across the entire market. So that happens in things like recessions, or obviously we've recently been through a pandemic not that long ago. That was a great example of everybody's money kind of declining in value, whether you were invested in individual stocks and shares or you were in ETFs, because that was obviously a huge financial impact on the economy. So just an example there of sometimes your money can go down if those big shocks hit the economy. And as mentioned before, the other real big risk is, particularly if you choose an ETF that is focused on a niche or corner of the market or a specific set of commodities, because you do run the risk in that element of, if that area of the market doesn't perform, or let's say something happens that shocks the market. Say you're in commodities, oil's a really good example of this. You're in commodities and you invested your money into an ETF that contains oil, and then something globally happens. Obviously, we know some of the things that are going on around the world at the moment. They can have a really big impact on certain markets, and commodities would be a good example of that, of where your money could decline really quickly in a short space of time. So the thing with ETFs in general is it's impossible to fully mitigate away from risk. You're invested in the stock market, and when you're invested in the stock market or the commodities market, there is always risk that your money could go down as well as up. But if you're investing for the long term, which is the real key message here, overall, ideally you will come out up across that time period. And if you look through historically through the S&P 500 and ETFs associated to that, or commodities and things like that, historically they've always seen net gain over an extended period of time. And that's what we're about here, really, is investing your money for a long period of time to be eventually to be able to lead to financial freedom or a comfortable retirement in the future. So as long as you're not looking to swap your money in and out of ETFs on a really short kind of time scale, then overall ETF investing is a good way of being able to grow your wealth over the long term. But before you do invest in ETFs, just make sure you understand what you're investing in. And as I say, it's really easy on a lot of trading apps that are out there now. I use Trading 212 to go in, have a look at an ETF. You can type that ETF's name into Google. It's very straightforward, and it will bring you up a lot of websites at the top straight away that you can click on, go into, and it will give you details. There's lots of info in there that you don't need, for especially if you're starting out and you may not be interested in. There's also lots of really useful information in there, such as what percentage of your money is split across certain countries if you're in a global ETF that invests in the USA and the UK and Japan and Australia and all of this, or if you're only invested in, say, the S&P 500, how that money is split by company. So you can get information really easy. Just make sure you know what it is that you're investing in before you put your money into it. So now this is your 5-step action plan as to how you can get started investing into ETFs if you decided it's the right thing for you to do. First thing to do is choose a platform. There are lots of platforms out there. If you're in the UK, in the US, there are a wide variety of options for you. As I say, I use Trading 212, but companies like Hargreaves Lansdown, AJ Bell, there's loads and loads of Nutmeg's, actually another one that I've used previously. There are lots of other options out there as well that you can use to get started on your investing and ETF journey. Once you've decided on your platform, step 2 is working out what's the plan. What are you looking to do? Are you looking to make money in the short term, or are you invested in this for the long term and you've got a 30-year time horizon before you're going to need that money? Because that will determine what direction you go down and what ETFs you invest in. So yeah, have a think about that now and think about what your plan is for this money. The next thing is picking your ETF, deciding where you want your money to go. You've decided what your time horizon is. Thinking about where you want your money to go and how much risk you're willing to take on is the next key thing. For me, I quite like a diversified portfolio. That means that I don't have to worry about swapping my money around too much. So I've picked out some very simple funds, which actually I'll put on the screen up here for you now, the funds that I've got in my portfolio at the moment. And what they do is give me coverage of the S&P 500 in America, then also global coverage across other stock markets. And then I've got an emerging markets fund in there as well, which covers off some smaller economies that might see some companies have really big growth in them, but that only makes up a small amount of my portfolio because there's a bit of risk associated with that as well. But effectively, those funds give me coverage across the entire world and the entire world stock market. And start small as well. There is no hurry here. There's no need to race forward. There's no need to pump all of your money in at once. Just start small and get comfortable with it. And the advantage of ETFs as well, particularly if you're using platforms like Trading 212, is that actually you don't need to buy one full share. You can buy a percentage of a share. So you can start really small, get a feel for it, and just see how you're going. And then lastly, stay consistent. Set yourself up a direct debit every month, no matter how big it is, that just keeps adding money into your account in small amounts. And over time, you'll see that money hopefully grow and grow and grow, which will increase your confidence in investing in ETFs. So there you have it. That's a breakdown on ETFs and how to invest in them and what the pros and cons are. ETFs make up a huge part of my portfolio. In fact, they make up most of my portfolio because they suit my objectives. And if I go through that checklist of what I set out originally, I chose my platform. Initially, I started with Nutmeg. I recently moved to Trading 212 because it has lower fees for what I need to do. I had to think about my time horizon. I'm invested in this for the long term. My plan is to ultimately be able to retire early, but we're talking 20, 30 years down the line. We're not talking in 5 years' time. So I've set my time horizon. I wanted exposure across the world. I didn't want to have all my money in one place that enhanced my risk. So I picked out those funds that I showed you on the screen a minute ago because they give me a full platform and profile across the world, and they diversify my money across all different countries as well as all different industries. And I've now set myself up a direct debit that goes into that account every month. I've also got my pension, which sits separately at the moment. I have my pension that goes into my workplace pension through a provider that my work works with. So I have money in there as well. I actually need to do a bit of work with that account on setting up where my money's invested there as well. If you haven't already, go and check out one of my other videos on pensions as well, and how your money's invested and how you can make choices about where your pension money goes. But for this purpose, I have an investing account separate, my trading 212 account. And yeah, I've just recently set that up, moving my money over from Nutmeg, and have picked those funds that I showed you because they give me the best, diversification across markets, and I'm contributing to it a small amount each month so that I can see how it grows. So it really is a simple step process of being able to get yourself up and underway investing in ETFs. And they're really useful if you're not someone that wants to spend the time picking out individual stocks that you think are going to win over the long term. Then investing in ETFs is a much more controlled way of being able to get full exposure for the market. Of course, your money's still at risk, but you're not having to worry on those individual companies performing well because you've got a spread of lots of different companies. So yeah, hopefully you found that really interesting, and hopefully you've learned a couple of things there about ETFs, or this video has maybe inspired you to look into ETFs and see if they're the right thing for you. Hopefully you've enjoyed it. If you have, please do make sure you subscribe to the channel, like this video, drop a comment with any thoughts or any ideas for future topics you want me to cover. But yeah, other than that, I will hopefully see you in the next video.